What if I told you that the people who control the world's money don't actually print money at all? That the most powerful financial force on the planet doesn't operate from a mint, a vault, or even a government building, but from a shadow system built on signatures, algorithms, and promises that almost no one understands. This is the story of how a small group of invisible credit masters quietly replaced real money with debt, replaced savings with leverage, and replaced democracy with a financial operating system where the players change, but the rules never do. Most people think they're paid in dollars, euros, or yen. They're not. They're paid in claims on future labor issued by institutions whose power was engineered, not voted on. And the real twist: this global system didn't appear suddenly. It evolved through a series of crises and political bargains, each one pushing humanity another step away from hard money, and another step toward a world where credit, not cash, determines who rises and who falls. Tonight, we unravel the secret history of how the world's money supply was hijacked, one emergency measure at a time. To understand how we got here, we need to go back not centuries, but to a series of moments where governments, bankers, and central planners discovered something addictive. Issuing credit is more profitable than storing money. Every empire learned this lesson differently. The Romans diluted their silver coins. The British used bills of exchange to fund global expansion. The Chinese experimented with paper currency hundreds of years before Europe even considered it. But the true revolution didn't come from printing money. It came from learning how to create credit out of thin air, and then convincing the world to treat that credit as money. And so, the seeds were planted. A financial structure emerged where the most valuable commodity wasn't gold or silver, but trust. Trust that a bank would redeem your note. Trust that a government would honor its bonds. Trust that financial institutions would never, ever, take risks that could bring the entire system down. Spoiler, they did. The story begins in the late 17th century. When England faced a problem, the crown needed money more than taxes or treasure could provide. And so, in 1694, a new institution was born, the Bank of England, a private entity at the time, created to lend money to the state in exchange for extraordinary privileges. This wasn't a bank in the modern sense. It was an experiment and engine that turned government debt into tradable money. The logic was simple. If you could create credit by issuing a promise, you didn't need gold, you only needed trust. This was the first major pivot away from metal-based money. The world didn't realize it yet, but the blueprint was set. Central banks would become the largest creators of money, not through printing, but through lending. Government debt became the collateral for national money supplies. And with each war-rich emergency, each crisis, more credit was created, more promises were written, and more power flowed toward those who controlled the issuance of credit. Fast forward to the early 20th century. Industrialization demanded bigger markets, bigger governments, and bigger financial tools. In 1913, the United States created the Federal Reserve, another central bank, with the ability to create money by expanding credit. But here's the twist. Unlike the gold-backed money of the 1800s, this new system allowed banks to multiply deposits using something called fractional reserve banking. If you deposited $1,000, the bank could legally lend out most of it, creating new money in the process. Paper claims multiplied far beyond actual reserves. This wasn't fraud, it was policy. Credit became the real money supply. The more banks lent, the more money existed. The more people borrowed, the more the economy grew. Debt wasn't a burden anymore, it was fuel. By the 1920s, the world's major economies were no longer running on gold, they were running on confidence. Confidence that loans would be paid. Confidence that central banks would intervene. Confidence that nations could accumulate debt indefinitely without collapse. But confidence is fragile. And when it breaks, systems built on promises crack first. In 1929, confidence shattered. The Great Depression exposed the entire system. Banks had created too much credit, backed by too little reality. When deposits were withdrawn, the money vanished because it never truly existed. The illusion collapsed. Governments responded by tightening control. Regulations increased. Central banks gained even more power. Yet the underlying model remained unchanged. Create credit gives, expand money supply, gives grow, economy gives, crisis gives, reset gives, repeat. Then came the biggest transformation of all. After World War II, world leaders attempted a compromise, a global monetary system that would restore stability while still allowing nations to expand credit. The result was the Bretton Woods system, where the US dollar was backed by gold. Every other currency was pegged to the dollar. For a moment, trust had a foundation again. But there was a flaw, a fatal one. The United States issued more dollars abroad than it had gold to back them. Foreign governments noticed. By the late 1960s, gold demands surged. Confidence wavered. Then, in 1971, Nixon made a decision that changed the world forever. He closed the gold window. The dollar was no longer redeemable in gold. And with one announcement, he ended the last physical anchor holding the global monetary system to something real. Money became pure abstraction, number in a ledger, backed only by government decree. This was the moment the invisible credit masters stepped fully into the spotlight. Once money lost its anchor, credit creation exploded. Governments could borrow without limits. Banks could lend without meaningful constraints. Corporations could leverage themselves at unprecedented levels. Debt-to-GDP ratios soared. Consumption replaced savings. Bubbles became features, not bugs. The global economy behaved like an engine running on leverage. More credit meant more activity. More activity meant more profits. More profits meant more lending. Central banks, once risk-averse guardians of stability, became dealers supplying liquidity to keep the system alive. Interest rates fell decade after decade because the world needed more and more credit to avoid collapse. And then came the moment that revealed the truth, the 2008 financial crisis. It exposed the entire structure. Mortgage-backed securities weren't the real problem, they were the trigger. The deeper issue was a global system addicted to credit growth. To prevent total collapse, central banks printed trillions, slashed rates to zero, and expanded their balance sheets to historic levels. The invisible credit masters didn't lose power during the crisis. They gained more. The system's survival depended on them. A new era had begun. After 2008, leaders promised reforms, better oversight, stronger regulations, safer banking. The solutions addressed symptoms, not causes. Quantitative easing created asset bubbles. Near-zero rates inflated housing and stock markets. Governments borrowed more to fund stimulus packages. Global debt doubled in a decade. Then 2020 arrived. Lockdowns shut down economies overnight. To keep the machine running, central banks created money at a speed never seen in human history. A decade of money printing happened in a single year. Inflation followed. Currencies weakened. Living costs surged. The credit masters had kept the system running. But at the cost of economic gravity. The world drifted further into a realm where credit determines value more than production does. And now, we're entering the most dangerous phase of all. If history teaches one thing, it's this. Every credit-based system eventually reaches a point where the promises exceed reality. Today, global debt has exceeded $315 trillion. That's more than 350% of total world GDP, meaning the world owes more than triple the value it produces each year. It is mathematically impossible to repay. The pattern is clear. Crisis gives intervention, gives more credit, gives temporary stability, gives bigger crisis, gives repeat. The reason is simple. When money is created as credit, the system must expand or collapse. There is no steady state. Meanwhile, central banks now own massive shares of their nation's government debt. They've become the lenders of last resort, increasingly the lenders of first resort. Countries rely on them. Markets rely on them. Corporations rely on them. And here's the twist nobody sees. The more dependent the world becomes on credit, the less relevant traditional governments become. Real power now sits with those who decide how much credit exists, who receives it, what the price of money is. When liquidity is injected, when liquidity is withdrawn, these decisions influence everything: housing prices, job availability, national debt, inflation, and even political stability. The invisible credit masters don't need to control governments. Governments need them. But something unexpected happened in 2009. Out of the ashes of the financial crisis, small group or perhaps a single person released a white paper titled Bitcoin, a peer-to-peer electronic cash system. At first, nobody realized the significance. Bitcoin wasn't just digital money. It was an attempt to build a financial system outside the control of credit creators. A system with fixed supply, transparent rules, no central authority, no ability to create debt-backed money. Bitcoin isn't just a currency. It's a referendum on the global credit regime. Some see it as the ultimate escape hatch. Others see it as a threat to the existing power structure. But one thing is undeniable. Bitcoin exposes a fundamental truth that the value of money today is a political decision, not an economic one. And that terrifies the old system. Take away one, money is no longer value. It's leverage. Most of what we call money is credit created by banks. Understanding this changes everything about how you view economics, politics, and personal finance. Takeaway 2. The system is designed to expand forever. Credit-based money must grow to survive. This means more debt, lower rates, and increasingly aggressive central bank interventions. Takeaway 3. Alternatives are emerging because trust is fading. Bitcoin, gold, and decentralized finance aren't fads. They're reactions to a system that has stretched trust to its breaking point. We are living in the endgame of a 300-year financial experiment, one where credit replaced money, and promises replaced value. The invisible credit masters aren't villains. They're simply operating within the incentives of the system. But the system itself is reaching limits that no amount of liquidity injections or emergency measures can permanently solve. The next decade will reveal whether humanity reforms the system, or whether the system reforms us. If you want more deep dives into the hidden history of money, global debt, and the financial mechanisms shaping our lives, subscribe and turn on notifications. Because understanding how the world's money supply was hijacked isn't just knowledge, it's protection.